Good morning and welcome to the webinar of the Actuarial Association of Europe, Wakeup Call. How and why people's awareness on pensions issues should be raised. This webinar is the third and in fact the last of a series of 3 Social Security Subcommittee decided to offer as a follow-up to the topics of Social Security Forum panel discussions. The last panel was focusing on raising people awareness, because the more people understand the world of pensions, the more possibilities can see for their future. So here we are this morning to enter deeper on the subject with our excellent speakers, Professor Nicolas Barr from London School of Economics, Professor Diego Valero from University of Barcelona and Chair of Novaster, and Gregorio Gil de Rozas, the Head of Retirement and member of the Executive Committee of Willis Towers Watson. Thank you very much. You are with us today. I would like now to invite Mrs. Tatiana Bitunska, the Chair of Pensions Committee, to welcome you all on behalf of the Actuarial Association of Europe. Tatiana.
Thank you, Maria. Good morning, everybody. I'm extremely happy to have so many participants on our webinar today. Today, we are participating in this webinar united by our interest in issues related to the pension system, to pension individuals' rights, to pension gaps, and questions like stability of the public pensions. As professionals, we believe that awareness on pension issues should be raised. From my perspective, this is really an existential question, almost the same as the meaning of life. We need to do something. We need to be satisfied with what we do. And last but not least, that what we do should be useful to others. Therefore, any discussion about pensions begins with a number of questions, such as what is life expectancy, what is our health status, how can we predict when we will need support from others or from society or from our relatives. Also, what is the people's ability to make informed decisions? And finally, our ability and the willingness, which is more important, to learn, to requalify and to retrain and apply new skills. Here, I will refer to one famous book written by Hector Garcia and Frances Miralles, Ikigai. Probably more of you are aware about this book. What I took away from this book is a beautiful concept of Ikigai, which can be translated as the happiness of always being busy. We can consider this a little bit quite a different concept from Japanese compared to our West type of way of thinking. I'm very happy to have such fantastic speakers today as Professor Barr, Professor Valero, and Gregorio Gil de Rozas. Their contribution in a number of areas of public policy, higher education financing, pension reforms, and also a role of actuaries and their contribution and support to society will make today's webinar extremely interesting and valuable. Thank you all for being here with us today. Now, I give the floor to my colleague Tibor Parniczky, who will facilitate and moderate webinar session. Tibor, the floor is yours.
Thank you, Tatiana and Maria. To start with, I would like to give you some householding announcements. First of all, that this session this morning will be recorded, and you will be able to get this recording later on from us. The second thing is that during the presentations, we will postpone questions for according to the webinar agenda. That the Q&A session will be at the end of the presentations. And having said that, I would like to use this opportunity to make my introduction very short, just to say that today's three presentation will have started by Nicolas Barr with a greater overview of the topic, and then we will have later on some more European approach to our topics, and we also have a very specific experience from Spain, although not this in order, but this is a from top to down approach, I would say rather. Our speakers will focus on how to make the pensions accessible or understandable for people, and how should it be formed by communication and other tools to make better choices on pensions. Having said that, I would like to introduce to you our first speaker. Our keynote speaker today is Professor Nicolas Barr. Nick is a professor of public economics at the London School of Economics and one of the most influential voices in the economics of the welfare state. His scholarship has shaped generations of thinking on the role of market failures in explaining and justifying social protection systems. He is author and editor of more than 20 books, including the landmark The Economics of the Welfare State. With Nobel laureate Peter Diamond, he co-authored The Pension Reform, A Short Guide, and other books widely respected contributions to the debate on pension design and reforms. Professor Barr's influence extends far beyond academia and pensions, and well known for raising critical voice on mainstream ideas, served on major international policy bodies, and advised governments across the 7 seas, including UK, Australia, Chile, Hungary, Poland, New Zealand, and South Africa, and others. Please join me in welcoming Professor Nicolas Barr, the foremost experts on economics of aging, pensions, and social security. Please start the presentation.
Well, good morning, everybody. Let me start by sharing my screen. So I hope you can now see my screen. I'm going to start off briefly outlining the problem, but we all know what that is. I'm then going to spend most of my time talking about consumer choice and how useful it is, both in terms of theory, but then in terms of a practical example of a pension design that takes account of the limitations of consumer choice. What I'm going to be talking about, as Tibor has hinted at, is I'm going to draw on joint work with Peter Diamond. The book that is illustrated on this slide, our 2010 book, which Diego Valero translated into Spanish. And we're working currently on a book that we hope will be out within the next year or two. So what's the problem? They're well known. There's an increasing difficulty in many countries of financing old age pensions in a way that's both adequate and sustainable. There's controversy over analysis and policy. There's huge debates about the right theory and big debates about policy. And the main point of today's webinar, the fact that many people don't make good choices about pensions and retirement. So the essay question that the conference organizers set was how and why people's awareness on pension issues should be raised. Now, I'm not convinced that that's the question I would ask. I would rephrase the question and say, how should one design pensions in ways that accommodate the fact that many people do not make good choices? I'll come on to financial literacy later on in my talk, but there are some people who say the reason people make bad choices is they're insufficiently financially literate, and if one could improve financial literacy, that would solve the problem. And I'm going to sound a skeptical note about that in the course of this talk. So my main point, my main argument is don't overstate the usefulness of consumer choice. And let me start by talking a bit about what people do. Now, these are all mistakes that people make. A lot of the evidence comes from the United States, but applies arguably even more in countries where involvement in financial markets is less widespread than in the United States. Consumers often don't save enough. They retire too soon. They delay choice or make no choice. In Sweden, in part of their pension system, workers are supposed to choose a pension fund originally from over 800 pension funds, now from about 400 pension funds, and sort of over 95+% of new workers don't make a choice. They go into the default fund. So workers delay choice or make no choice, or they choose an unsuitable portfolio. They make all sorts of mistakes. They choose an actively managed fund when a passive fund might be more suitable. They may be inadequately diversified. In the extreme, they may hold shares in the firm in which they work. They trade too much or at the wrong time. They hold on to equities too close to retirement rather than de-risking and moving into bonds as they approach retirement. They may take insufficient account of family members. If they buy an annuity, it might only be a single life annuity. And typically, they don't take charge of they don't take account of administrative charges. So consumers often get things wrong, and firms exploit asymmetric information with high charges, often that bear little relation to fund performance. They may give biased advice. They may steer people towards products with whom the firm gets a higher commission. And at worst, there can be outright fraud. So this is just a description of what happens. And the question is why? And the answer is complexity and limited capacity to address complexity. Economics starts from a simple model, well-informed consumer, rational behavior, etc. And that's a very useful model as a benchmark, but it's a bad basis for policy design. If one asks the question not what is the world of simple economic theory, but what is the world in which we actually live, that's what economists call second-best analysis, illustrated by multiple Nobel Prizes over the past 30 years, which take account of the ways in which the real world is not like the simple model. People have imperfect information. They behave in irrational ways. There are search costs, incomplete markets, incomplete contracts, distortionary taxation. And as I say, a bunch of Nobel Prizes have been awarded over the past 30 years for work that unpacks and explains these problems. So let me talk about one or two in a bit more detail. Imperfect information. I mean, in many areas of social policy, the model of the well-informed consumer doesn't hold. In the context of pensions, in a survey, 50% of Americans didn't know the difference between a stock and a bond. Now, at this stage, at the London School of Economics, I look at my audience of graduate students and I say, put your hand up if you really know the difference between a stock and a bond. And about 1/3 of hands go up. and another 1/3 you sort of see people sort of tentatively raising their hand. Now, if at a place like the London School of Economics, graduate students aren't sure of the difference, then amongst the population at large, it's unrealistic to assume that people understand those things. Most people don't understand the need to shift from equities to bonds as they age. And few people realize the significance of administrative charges for pensions. In Britain, it is illegal for me to give advice on pensions because I'm not, I don't have a qualification as an independent financial advisor. But the one thing I always do tell people is to look at the administrative charges. And what I tell them is that if your pension fund charges you 1% of your accumulation each year to manage your fund, then over a full career, your accumulation and hence your pension will be 20% smaller because of that 1% charge than it would have been without it. And a lot of pension funds charge more than 1%. So it's perfectly possible that between 1/3 and 40% of a worker's savings doesn't reach them in old age. So you've got problems of imperfect information. You've got problems of that financial literacy is shockingly limited. This slide relates to an international study of financial literacy, and participants were asked 3 questions. And I'm only going to outline the first question. You've got $100 in a bank account. It pays 2% interest a year. After 5 years, how much would you have in the account? Less than $102, equal to $102, more than $102. And the other 2 questions are equally simple. In the United States, the heart of capitalism, only about 35% of respondents got all 3 answers correct. And in sensible, well-run countries like Sweden, Japan, and New Zealand, only about 25% of respondents got all 3 answers right. So there really is a big issue about the quality of financial literacy. So you've got imperfect information, you've got non-rational behavior. And what simple theory says is people will choose voluntarily to save the right amount to maximize their lifetime utility. They will retire at the optimal time, and they will convert the optimal fraction of their pension wealth into an annuity. That's what the simple model says. What actually happens are 2 problems. What economists call bounded rationality is the first. This arises where the problem is too complex for people to know what they ought to do, even if they're given the information. So people procrastinate, they delay saving. Inertia, they stay where they are. In theory, it should make no difference whether the system is opt-in or opt-out, but in practice, as we know, automatic enrollment leads to much higher participation. And there's problems of immobilization. People know they ought to do something, but they don't know what they ought to do, and so they do nothing. So you've got bounded willpower, bounded rationality. Separately, you've got problems where people know what they ought to do, but they don't do it. In particular, people know they ought to save, but they don't save or don't save enough. And it gets worse because it's not only people who can't make good decisions, the previous slide, but also people who do have the knowledge, but they don't actually make rational decisions. So this is behavior by financially knowledgeable people given constraints of time, energy and attention. And in the book that Peter Diamond and I are writing, we say people often don't review their pension arrangements often enough. And then there's a footnote and it says, this is true of both of the authors of this book. The point being that Peter and I have better things to do with our time, like writing books together or watching baseball at Fenway Park or playing with our grandchildren. So the conclusion that I would draw from empirical evidence and economic theory is that consumer choice, the usefulness of consumer choice in pensions, is overrated. So What does that tell us about pension design? Well, I would say the aim is to design pensions in ways that accommodate the fact that many people make bad choices. So the first lesson is that choice and competition is the wrong model. Choice and competition works brilliantly for restaurants and low-cost airlines, for all sorts of things. But pensions are complex, and systems in which workers have to choose from competing private pension providers face information and behavioral problems and have high administrative costs. Now, that isn't a condescending attitude from an elderly professor of economics. We don't allow people free choice of pharmaceutical drugs. And none of you, I assume, is allowed, in whichever country you are, to go into the pharmacy and buy opiates or antibiotics, etc., over the counter. You need a letter from your doctor, a prescription. And that's precisely because pharmaceutical drugs are complex, and most people, I mean, unless you're a trained clinician, people don't have the pharmaceutical knowledge to choose their medication effectively. And I would say pensions are much more like pharmaceutical drugs than they are like low-cost airlines or smartphones. So I would argue that the model of choice and competition is the wrong one. It uses the simple economic model, which is the wrong model. The second lesson is that giving people less choice, paradoxically, is part of good policy design. The problems of choice I've already outlined: bounded rationality, bounded willpower, and the fact that giving people choice is administratively costly. And in the face of those problems, giving people too much choice actually lowers their welfare. So the policy directions that suggests are that you should give people only a limited range of options to choose from, and only a limited range of choice about how much they save. And the third lesson is not to overstate what financial education is capable of achieving. Financial education is useful and important. It ought to be a mandatory part of high school syllabuses. Young people need to learn why maxing out on their credit card is a very bad idea. So financial education is useful and important, but there are limits to what it can realistically be expected to achieve. And even for well-informed people, there are high transactions costs comparing complex options. So when Peter Diamond and I were asked to advise an Australian commission in 2017, the principles we came up with were twofold. First of all, if a person wants to make choices about pension and retirement, the system should assist them. But the pension system should work well for someone who makes no choice, and making no choice should be a perfectly acceptable option. And I want to give an example of a pension design that complies with those two principles. And that's nest pensions in the United Kingdom. To reprise my earlier point that the model of choice and competition is the wrong one, choice has high administrative costs, and consumers don't do a good job of choosing. So if those are the problems, what does that tell us about pension design? Well, first of all, it says one should make pensions mandatory, or if that's politically not possible, use automatic enrollment. Secondly, keep choices simple. Highly constrained choice is a deliberate and welfare-enhancing design feature. Thirdly, there will be people who won't make choices. So for them, you include a good default option in which people are put into mainly equities when they're young and automatically rebalances towards less risky assets as they approach pension age. And the fourth thing is to keep administrative costs low. And you do that by decoupling two parts of the problem. Account administration is record keeping. It's the back office stuff. Fund management is the question of who decides what to do, what assets to buy with worker savings. And so what Nest does, and the way to keep administrative costs low, is you have centralized account administration to get economies of scale. Fund management can either be done wholesale, sort of outsourcing parts of the portfolio to private fund managers, or it could be done through a sovereign wealth fund, of which the closest example is Norway. So examples of that sort of design, the earliest such design was the US Thrift Savings Plan for federal civil servants. It was initially voluntary. It's now got auto-enrollment. Workers have a choice from 5 funds. There's centralized account administration, and there's wholesale fund management. The Thrift Savings Plan managers outsource the fund management to private fund managers on a competitive basis. But interestingly, the fund managers have to run the same portfolio for their private clients as they do for the Thrift Savings Plan in order to insulate investment from political interference. So the Thrift Savings Plan is the earliest example. The UK National Employment Savings Trust, Nest Pensions, is similar in design to the Thrift Savings Plan for similar reasons. Now, when it comes to pensions, my country, the United Kingdom, offers the world many useful lessons about how not to do things. But Nest is a rare example of where we've got something right. And my view is, if a country wishes to have individual funded accounts as part of its system, the Nest approach is the way to do so. Now, of course, countries don't have to have individual funded accounts as part of their system. Many countries with good systems don't. But if they do want that individual accounts, I would say this is the way to do it. The plan can be instead of other plans, or as in the UK, as well as other plans. The design is explicitly based on the findings of behavioral economics and takes account of the limitations of consumer choice. It's got 4 key elements: automatic enrollment, limited choice, centralized account administration, and wholesale fund management. In other words, exactly the 4 things that in an earlier slide are the implications that one should derive from the limitations of just leaving things to market demand and supply. So let me talk a little bit about each of those elements of Nest in more detail. Limited choice, the default. So workers are automatically enrolled in a simple savings plan. The default is a target date fund where the target date is the year in which the worker will reach state pension age. And the target date fund has got 3 elements. The foundation phase is the first 5 years or so, and this is a novelty in pension design. With auto-enrollment, workers who see a loss in the early years might be discouraged and might stop saving. So to prevent that in the early years, to avoid losses in the early years being profoundly discouraging, the strategy during this phase invests conservatively to avoid reducing the value of the small accumulation. The growth phase then adopts a less conservative approach. Nest's aim, so far successful, is to produce a long-run average annual return over and above administrative charges of 3%. And then the consolidation phase starts to crystallize the gains, moving into less risky assets. So that's the default. Then you've got additional options. If a worker wants to make choices, they've got 5 other choices. There's a higher risk fund with potentially higher growth, a lower risk fund, an ethical fund, a Sharia fund, and a pre-retirement fund. So workers can make choices, but those choices are limited and the funds are simple enough that workers can understand the difference between them. You then have centralized account administration. Nest maintains all individual records. It decides in-house on overall exposure to building block funds and asset classes. In other words, the fund managers decide what fraction of the savings they get goes into UK government bonds, corporate bonds, UK equities, global equities, etc. So that's decided in-house, but the decision about how to manage, let's say, the global equities portfolio is outsourced to the private sector. And Nest publishes quarterly updates. And this slide is far too small for you to see the components of the Nest fund, merely to show you that it's subdivided into a lot of funds, and these data are published every quarter. Charges. Well, for employers, Nest is entirely, it's 100% online. Employers have compliance charges. They have to manage their bit of the system, but don't pay any charges. Members pay an annual management charge of 0.3%. In addition, there's a temporary charge of 1.8% of contributions. The reason for that being that Nest was set up using government money, but in order to create a level playing field with private pension plans, that money was a loan, which Nest is repaying through that temporary charge. And once they've repaid the loan, that temporary charge will disappear. So basically, you've got something with limited choice and low administrative charges. And the obvious question is, well, how well is it doing? The answer is it's doing very well. As of March 2023, this is a quote, the 2040 Nest Retirement Date Fund, which currently represents the growth phase, has delivered annualized net returns, in other words, net of administrative charges, of 7.3% over the past decade, outperforming its objective of 5.8%. So the fund has done well. One of the problems, however, is that with automatic enrollment, workers can choose not to enroll or not to save. And one of the reasons they might choose not to is they may be nervous about locking up their money until pension age, which may be 30 or 40 years later, because they may need some money in the short run. So Nest is experimenting with something that it calls a rainy day fund. And the way that works is that the first contributions that a worker saves remain liquid. And what they're experimenting with is say the first £500 or let's say $1,000 that a worker saves goes into a liquid fund. And it's only once their fund gets over $1,000 that then the excess over 1,000 goes into the pension fund, which the worker can't access until they reach pension age. And that means that alongside liquid retirement savings, there is an element that can be drawn down for short-term reasons like a medical emergency or an expensive car repair. So pension savings would be invested for the long term, but still give workers access to an amount of liquid savings. And this is still in an experimental phase. And an obvious question is, how large should the liquid part of the fund be? But I think the idea of having a hybrid with mainly locked up till pension age, but with a liquid element, I think is very important and very clever. And I shall watch with interest how this proceeds. So what do we make of this design? Well, it respects the lessons from the economics of information and behavioral economics that I talked about earlier. The plan is simple. It simplifies choices for workers. There's automatic enrollment. Workers who make no choice go into the default fund, and that works fine. It keeps administrative costs low. As I've mentioned, the plan can be alongside other plans or instead of them. It can incorporate a liquid element. And finally, and this is sort of, if you like, an economist's point, it locates competition in the right place. And let me explain that. Financial markets have the hugely important task of taking the savings of people like you and me and translating those savings into productive investment. But financial markets work well only when you've got knowledgeable people on both sides of the market. Now, in a market where on one side you've got the individual worker and on the other side the fund manager, the professional fund manager, that's not a balanced market because one side of the market is better informed than the other. With Nest, on one side of the market you've got professional fund managers. On the other side of the market you've got the financial professionals in the Nest management. So this is actually a way of producing greater efficiency in financial markets and hence greater efficiency of investment, which is an advantage of the Nest type design that I don't think is mentioned often enough. So I think that's important. Coming back to communication, which is what today's webinar is largely about, Nest regards communication as very important. Nest has a vocabulary police. There are certain words that you're not allowed to use. You're not allowed to use the word annuity because that's technical. Nest publications refer to pension income. So their idea is you use words that journalists might use, not words that academics use, and you use simple words that people can understand. So there really is a major issue here that the strategic question is, how much do you rely on individual choice? And my argument and my key takeaway is that the usefulness of choice shouldn't be overstated. Empirical evidence shows that many people make bad choices. Economic theory gives powerful explanations of why that is the case. That's reinforced by the fact that even people who are knowledgeable don't necessarily do the right thing. And let me now throw my hands up with a bit of a cry of despair. Peter Diamond and I, Peter Diamond, Nobel Prize winner, one of the great theorists of his generation, we were on a Zoom call and we said to ourselves, supposing we are 35 years old and we have a master's degree in finance and we're asking ourselves the question, how much should we save for retirement? And the conclusion we came to was that there is so much uncertainty about our future earnings, about whether or when we will marry, how many children we will have, our earnings prospects, the medical and educational needs of our children, etc., that we came to the conclusion it's actually an impossible problem, even if you've got a master's degree in finance. So it emphasizes my point that the usefulness of choice should not be overstated. So constrained choice, giving people less choice, can be part of good design. Financial literacy, as I've said, highly desirable, but one needs to be realistic about what it can and can't achieve. And there's a lot that it can achieve, particularly in the realm of civics, of day-to-day life, of using credit cards wisely. It doesn't turn people into financial market sophisticates, just as we all have some knowledge of medicine and healthcare, but that doesn't turn us into medical doctors. So, as I said at the start, yes, raising awareness, people's awareness of the need to save, which is the question this seminar is addressing, is an important one. But as I said, I would rephrase the question, how should one design pensions to accommodate the fact that people don't make good choices? So to end with the two principles that Peter and I urged when we advised the Australian government, that if a worker wants to make choices about pensions and retirement, then of course the pension system should help them doing so. But you should design a system that works well also for workers who make no choice. So let me leave it there. Thank you very much. And I very much look forward to hearing what the other speakers have to say, to interacting with them afterwards, and then to hearing what you in the audience have to say by way of questions or comments. Thank you very much.
Thank you very much. And I think that we got lots of insight from the general background and a very interesting specific example of a good solution at this occasion from the UK, outside Europe. I mean, inside Europe and outside Europe. So, okay, yes, but still in pensions, I think there are lots and lots of things to learn from theory and experience from the UK. And thank you for keeping your time schedule and leaving time for questions, which I am sure we will have lots of discussions about this later on. And having said that, let me introduce our second speaker for today. Now we jump into a specific example of Spain. Our next speaker is Gregorio Gil de Rozas, one of Spain's leading pension professionals. With more than 30 years of experience in the field, he has advised major Spanish multinationals, IBEX certified companies, and global firms including Santander, CaixaBank, Telefónica, IBM, and Barclays. He is head of retirement and member of its executive committee at Willis Towers Watson, Spain, and a leading figure in actuarial and pension profession. He currently leads the Social Security Investigation Group and the Pensions Committee at the Spanish Actuarial Association. Earlier, he served as chairman of the association. He is also a vice chairman of the Spanish Pensions Consulting Association. Please join me in welcoming Gregorio. The place is yours.
Thank you very much, Tibor. And thank you very much to the Actuarial Association of Europe in order to selecting Spain, in this case, as one of the best practices in terms of sharing our know-how, our investigation, our work with the society. Okay, I'm going to spend these 15 minutes sharing with all the audience what we have performed during the last years and here in Spain, and what we continue doing, because in fact, and we'll talk later about that, we are these days working on a new paper that in the next days, weeks, we will share with the society again and with all the parties in order to provide our view about other questions that I will share with all of you later. Okay, so the content of this brief presentation is what we have done, how this connect with the Actuarial Association of Europe vision and the values, okay? Of course, this is fully aligned with the values and the vision that the Spanish actuarial profession has as well. I will share some details about the context that we have been living during the last years in Spain, and which was the situation that drive us to found a committee that at the end of the day, this is the heart of this work that we are doing within the Spanish actuarial body, and a couple of examples and the impacts and next steps. Okay, so let me begin with that, in which, as you know, the vision of the Actuarial Association of Europe is focused on the actuaries throughout Europe to be recognized as leading quantitative professional advisors. We are going to talk about that, some quantitative exercise from our side in financial services, risk management, and social protection. We are talking about social security, okay, and contributing to the well-being of the society. Social protection is one of the major dimensions that as a society in Europe we have built, and we will to maintain and save in the future, okay? And even the idea is to be recognized or continue to be reinforcing this recognition as profession as one of the leading sources of advice on actuarial or related issues. Pensions, social security is one of the best examples that we have on the table in which our profession could help, okay? And on top of this, the values, concern for the public interest, this is obvious, integrity and independence. We are an independent body, collaboration, we set a group, and even transparency and accountability we are sharing, and these documents, these services that we are including in our reports are published in our public website, okay? So let me share with you about Spain, okay? So public pensions were, are, and will be one of the most relevant concerns for Spanish citizens. Probably this is going to be common for 100% of the European countries, okay? Spain as well. And in our case, politicians, journalists, unions, employee association, pensioner association, everybody were discussing about public pension issues, each one from their point of view. But we identified some years ago that the ideology and the demagogy was mainly guiding this reasoning, okay? And even in these cases where we have some votings, in the pre-voting campaigns, even this increase. So at the same time, we didn't see technical data, explanations with details. So it's more like we are going to do something and this is happening, but without sharing the consequences with the society, okay? So in this situation, we, the Spanish actuarial profession, through the Instituto de Actuarios Españoles, which is an expert and independent body, we wanted to provide technical analysis to the debate, being a new and reliable actor for that. So what has been done by ourselves? In this case, the Instituto set up a social security experts panel formed by actuaries and non-actuaries to provide ideas, anticipate problems, perform technical analysis and calculations. We'll describe which has been these papers performed up to today. Maintain professional and technical discussions with other relevant institutions that at some point they are indirect or indirect connection with this topic, the social security, okay? We want it to be a technical tool for politicians. That's important because at the end of the day, we would like to influence to the policymakers from a technical point of view, okay? As you could imagine, each of us, we have our own ideology, but within the social security expert panel and within the Spanish actuarial profession, this is out. So we are only talking about this technical part, okay? And finally, we wanted to provide clear and transparent messages and information to the society, okay? This group was formed in 2016, so we have been working for more than 10 years, okay? And currently it's formed by 15 members, okay? In this case, I have the pleasure and the honor to lead this group of people. And the technical coordination and the technical work is done by Enrique de Besa and Robert Meneu, both from the Valencia University, and they are the technical head of all this initiative. Okay, so thank you very much, Enrique and Robert, for your work during the last years. Okay, and on top of this, we have another 12 members. You will see, I will not go to each of the details, but you will see that we have people that are experts in this area, okay? Some of them from the most reputed universities in Spain and outside Spain, OECD. We have one ex-director of the Social Security, people, of course, from the Spanish Actuarial Institution, people from the other associations, and which is important is that the insights, okay, are fully endorsed by the Instituto, so by the board members, okay, and the opinions should not be considered as issued by individuals or by the institutions where they work. That's very important. So we have the know-how, we have the experience, we have the possibility to work with very well-known and reputed people, and we are sharing all together our views, but at the end of the day, they are so generous that at the end we are sharing that, we are compiling that, we are discussing that, and at the end of the day, all of this is included in our papers, okay? And this is the word of the Spanish Actuarial Institution, okay? So that's important because this was one of the concerns that some of the members had, and was fair. Okay, but I could share my view, but I'm not representing the entity. Perfect, but you have the know-how, you have the access to information, and they are sharing with us this. Okay, so we have published and communicated to the society the following papers. So the first one was in 2021. This was a first actuarial and financial assessment of the Social Security. In 2023, the second one, in which we were discussing or even having a public debate about the potential changes of the Social Security reform, okay, in 2023. So this was at the same time that the discussion was occurring. We were issuing our view with the society. We published, and we will talk later, about actuarial equity index, in which in 2029 and in 2025, okay, and these days we finish within the Social Security expert panel the document in which we are discussing, describing, and providing technical support to potential structural reforms to the Social Security. In this case, we are putting this on the table. We are not fully endorsing one or other option, but we are talking about 4 different options in which the system could be reformed. We think that this is going to be very, very well received by stakeholders. Okay. During these years and these days, we continue maintaining recurring contacts with most of the relevant political parties in Spain and parliamentary groups, which at the end of the day, it's key in order to influence the policy making people, okay, and with other relevant institutions. In this case, the Ministry of Social Security, for example, the Spanish Insurance Authority and Pension Fund Authority, which is dependent on the Ministry of Economy, or even the IREF, which is a relevant body in this case, which is the Independent Budget Control Institution. Our relationship is always from a technical point of view, okay? And it is relevant to share that even in one of the meetings with the Social Security Minister some years ago, we were proposing, okay, why we don't have an office of with a chief actuary? Okay, in this case, mirroring the Anglo-Saxon model that is working in the US, in Japan, in in the UK, or in Canada. So at the end of the day, the minister said, okay, we have this independent budget controlling institution, IREF, that at the end of the day, they have the mandate to control of the budgets for the administration, okay? And at the end of the day, we are sharing with them and working together in some way in order to provide this vision to the society. This independent institution is really independent, so they are not fully under control of the government, okay? So that's important, and there is a clear synergy and connection between our work and their mandate, okay? So let me share with you one example. So what is about this actuarial equity index? We wanted to share with the society through this technical advice and our work how we could say if our system is generous or not. So at the end of the day, we wanted to provide in a very simple way this to the society. So we calculated for a cohort of pensioners in these years that we performed the exercise in 2020 and in 2025. It's a very easy calculation for an actuary, which is calculating the present value of all the future pensions in comparison with the present value of all the past contributions. If at the end of the day, the ratio is higher than 1%, this means that the system is giving you more that you have contributed. So it's more generous than desired. So from a pure actuarial point of view, if the ratio would be 1, this would be neutral. You are contributing, and at the end of the day, you are receiving exactly the same. So in our case in Spain, when we calculated this actuarial equity index in 2020, we had 1.55. So these pensioners were receiving 55% more than the contributions that this cohort performed. And when we calculated again in 2025, even after the pension reforms, the ratio was 1.62. So this means that even this was worse than in the previous years, despite of the pension reform. So it's 62%. And even when we perform this for the future, we calculated which was our best estimate for 2045 and 2065, even this would be higher than 2 the ratio. So this we thought that this was one very easy way to share with the society the generosity of our system. Okay. We share this paper with our communication company. We have a lot of impacts in printing online, some TV. So the value of the campaign, not the cost. So the value was very, very important. So at the end of the day, this put in the news, on the debates, this topic, okay, and this was a national audience, okay, and a regional one, and even on the TV, as I mentioned, okay, and this is the way in which we usually work. So which are our next steps, okay? As I mentioned, the next steps will be to share with the society and the major stakeholders our paper in process, potential structural reforms to the social security. We would like to be a relevant part of any initiative that could propose or make changes to the pension legislation. Sometimes these changes are occurring in Spain, but sometimes are highly influenced from Europe. Okay, so even in both scenarios, Spain, Europe, we would like to be a relevant part. Okay, and also our aspiration is to provide technical and expert insights to the Parliament. Pacto de Toledo is the group of politicians that within the Parliament are discussing during the last 20 years. They have been discussing, no, more than 20 years. This was set up in 1996. about pensions, okay? We aspire to be a consulting party for the government, okay, and for those political parties that would consider technical assessment into their pension proposals, okay? And finally, and this is linked to the previous part, we would like to provide data and insights to the society in respect of intergenerational fairness issues, which is one of the major topics that people is concerned about. So more or less, this is what we have done, Tibor. So thank you very much for the opportunity. We don't hear you.
It's great that at least I heard you. Thank you. So thank you very much for your presentation. And I think it was a great example from Spain that actuaries were some kind of in between the profession and the public and also politicians. And this example is really good because what I really liked from your panel, that it was not just actuaries, but all parties who are interested in social security on your panel. So I think it was a great help to have a great communication. And you also talked not just with professionals, but journalists and the public in general too. So thank you very much for these presentations. And we now turn on the home stretch that our last speaker for today is Dr. Diego Valero, a distinguished expert in behavioral finance and pension economics, dedicating his career to understanding the human element behind financial decision-making. He is full professor at the University of Barcelona and co-founder and chairman of Novaster, as well as founder of BV, bringing behavioral insights directly into pensions and corporate finances. Dr. Valero has advised parliamentary pensions commissions in Spain and across Latin America, and he is the only Spanish member of the US Social Security Academy. As for Europe, he received the IPE European Outstanding Contribution to Pensions Award. He is also a prolific author and translator, including Peter Diamond's and Nicolas Barr's book on pensions. So please join me in welcoming Dr. Diego Valero. Diego, please.
Thank you very much, Tibor. It's my pleasure to be here with all of you. And I am a former member of this Social Security Subcommittee. So coming back home, it's great. Well, I liked to discuss some things about how behavioral architecture can help people get a better pensions. Today, we aren't just discussing the technicalities of pension models, but the systemic challenge of ensuring retirement income adequacy across mobile continent. To understand the gap between our deterministic projections and reality, we must look past the spreadsheets and start with a single representative human data point. Let's start with a quick census of this room. Please show your hand if you or a colleague you've advised have accrued pension rights in more than one European jurisdiction. So please, if you can show. Okay, exactly. Our portfolios are international, but our savings are siloed. Take David. David is our Chief Behavioral Officer. His career trajectory is a perfect map of European Union labor mobility. He has worked in Spain, Greece, Poland, and professionally, he's a seamless global citizen. But from an actuarial perspective, well, he's a fragmented liability. Consolidating his retirement savings isn't just a headache, it's a catastrophic loss of compound interest and density of contribution. David's story represents a cohort of 10 million European citizens working in other member states. This is a massive underserved market. To address this, the European Union introduced the Pan-European pension product, the famous PEP, a brilliant regulatory framework on paper. And yet, here's the paradox. Out of a potential market of 10 million mobile workers, how many registered PEPs providers do we see today in the official EIOPA register? Well, 2, just 2, only 2. This isn't just a market failure. It's an evidence-based signal that our industry has failed to account for the most volatile variable in the equation. It is the individual saver's decision-making process. To understand this paradox, we have to reframe the problem. This isn't a failure of product design or a solvency capital. It's an architecture failure. Let me explain. We expect the individual to navigate a straight path to retirement, but we have inadvertently built a labyrinth. This labyrinth is filled with many obstacles. Every regulatory hurdle and every complex disclosure is in fact an invisible wall that triggers a do-nothing response, breaking the models we rely on for long-term sustainability. The labyrinth exists because we traditionally design pension system for a creature that doesn't exist. This creature is the perfectly rational Homo economicus. But as Herbert Simon, the father of bounded rationality, taught us, humans do not optimize. We satisfy. We don't have access to all the data, and even if we did, our cognitive bandwidth is finite. In the face of pension complexity, the human mind doesn't calculate. It retreats. To build better systems, we must stop modeling for a perfect machine and start designing for a limited human brain. The labyrinth exists because we traditionally, the behavioral, this labyrinth is close to behavioral economics. Why? Because behavioral economics give us the map. Behavioral economics explains our mental operating system, which is divided in 2 parts. One is so-called System 1. System 1 is the fast, automatic, and intuitive pilot that makes most of our daily decisions, maybe around 95% of our daily decisions. On the other side, System 2 is our slow, analytical mind. As actuaries, our models are built for this System 2, the slow, analytical mind that understands compound interest and discounted cash flows. But the reality is that the saver operates on System 1. They operate in a fast way, automatic, and incapable of grasping the convexity of 40-year savings. The labyrinth isn't just a technical problem. In fact, it's a mismatch of operating systems. We design products for a rational agent that doesn't exist, while System 1 decides whether the accumulation phase even begins. To navigate this complexity, System 1 uses heuristics. These heuristics are mental shortcuts for a rapid, subjective decision-making. For us, these are sources of extreme model volatility. For instance, The availability heuristic leads a member to estimate their own longevity based on a neighbor's passing rather than a mortality tables. These shortcuts replace actuarial calculation with intuition, skewing expected contribution rates and retirement age assumptions, and also can lead to biases. Biases are predictable, systematic errors in our thinking. These are not random noise in the data. They are hardwired features. If our model assumes a rational response to inflation, but the money illusion bias persists, our target replacement rates will fall. These biases are the invisible walls that turn a clear pension path into a labyrinth. So now, with this scientific lens, we can return to David at the entrance of the labyrinth. And for the first time, we can truly see the walls. They are the cognitive biases we just discussed that break our deterministic models. The first wall is inertia, the powerful gravitational pull of doing nothing, born from our system one's desire to save energy. Actually, inertia is what creates a suboptimal participation rate. If enrollment requires an active choice, system one's desire to save energy leads to procrastination. This destroys the early accumulation phase, that is, the most critical yet for compound interest, and shifting that the entire burden of fund solvency to later and more expensive years. The second is sludge. Sludge is the swamp of bureaucracy and complexity that drains motivation and exploiting our limited cognitive capacity. For us, sludge is a tax on contribution density. Every complex form or Greek document David can't read is a point of exit. It drains the motivation to make voluntary top-ups, leading to leakage in the system and preventing the fund from reaching its target replacement rates. And the third is home bias. Home bias is the innate distrust for foreign products. It is a powerful heuristic that tells us to stick with what's familiar. These aren't just inconveniences. They are the very architecture of the problem. It is the primary reason why the PEP market remains stalled with only 2 providers. No matter how efficient our portfolio optimization is, if the user's home bias prevents them from selecting a pan-European product, we face a concentration risk that no mathematical model can hedge. These are just human story. They are the architecture of the pension problem we are tasked to solve. Let me give you a real example of a sludge from David's journey. While in Greece, he received an important looking document about his social security. The problem, it was, of course, entirely in Greek. Now, David's Greek is limited. He knows just one word, a very important word, ευχαριστώ. It means thank you. So he looked at this complex piece of paper, and all he could do was say ευχαριστώ and put it in a drawer. That is sludge. It creates inaction. But what if we could engineer a path that accounts for these cognitive limitations? Well, in fact, behavioral economics provides the process tools to do so. It's nudging, it's choice architecture, and a relentless operational focus on eliminating sludge. These aren't just psychological concepts. They are the blueprints for a more efficient and inclusive pension infrastructure. And the best part is that this is not just academic theory. It's a proving large-scale reality across the continent. We don't need to invent the tools to clear this labyrinth. We just need to look at our neighbors who have already forged them. To counter inertia, the UK implemented the shield of defaults through auto-enrollment. By shifting the participation choice from opt-in to opt-out, they leveraged the very inertia that previously hindered savings. The actuarial result, it's amazing. Participation rates surged from 30% to over 92%. They successfully transformed a behavioral obstacle into a powerful engine for fund accumulation. To cut through the swamp of sludge and complexity, Sweden forged the compass of simplicity. In their pension system, if you don't choose a fund, you are defaulted into AP7 SAFA. This default fund is a high-quality, low-cost life cycle fund, and it successfully manages the pensions of nearly 6 million people by protecting them from the paralysis of choice while ensuring market-leading returns. And finally, how do we dismantle the wall of home bias and distrust? Well, we can build a bridge of trust. Data from IOPA is conclusive. 56% of people trust their employer with their finance, compared to only 44% who trust pension funds. So the most effective strategy to increase supplementary pension uptake is to leverage this existing relationship using the employer as the primary facilitator for these essential financial choices. By applying these proven levers, so say defaults, simplicity, and trust, we create a new world for the European saver. A future where retirement capital follows the individual seamlessly from Madrid to Munich to Paris. A future where 10 million mobile citizens, a population equal to that of Greece, can enjoy a retirement that is simple, effortless, and actuarially secure. This is the promise of a truly single market that works for its citizens. But how do we build this world? The answer is in the European Commission's latest roadmap. We are witnessing a shift from hoping the individual makes the right choice to re-architecting the state through two powerful pillars. First, we need a compass. The Commission is pushing for pension dashboards. But don't think of this as just more data for the sake of data. These are strategic tools designed to give policymakers and citizens total transparency. By integrating national tracking systems, we aren't just measuring coverage or final costs. We are building the one thing money can't buy, that is public trust. Second, we need an engine. The roadmap officially urges member states to adopt auto-enrollment. We are finally applying what we've discussed today. the power of the force. Instead of asking David to solve a technical puzzle every time he moves, we automate his journey. We use inertia as a force for good, ensuring that participation isn't a choice you have to make, but the path you are already on. In 5 years, these national efforts will feed into a unified European Union dashboard. We are creating a system that doesn't just nudge, it scales. A system where transparency and automation work together to guarantee that no one is left behind in the labyrinth. Of course, for this behaviorally informed system to work, we need an infrastructure that can handle them. This is why the Commission is proposing a dual overhaul of our regulatory pillars. First, we are seeing a revision of the IOR2 directive. The goal here is simple: scale. Small fragmented plans are inefficient, and they can't provide the returns our citizens deserve. So we are moving towards consolidation, where larger professionally managed funds can drive costs down and performance up. And then there is the PEP. We have learned from the past years that strict fee caps and national sub-accounts requirements, while well-intentioned, but hinder the market. The new revision aims to breathe life into the PEPs. It's being redesigned to be flexible, competitive, and crucially, compatible with the auto-enrollment schemes we just discussed. Well, I will leave you with this thought. Science is clear, tools are proven, path is known. The individuals on this journey can't build this better world for themselves, but we can. Everyone in this room, regulators, providers, consultants, we are the architects of this new system. The question is no longer how to activate the PEP market, but who among us will be the architects to design and build this behaviorally informed future. Thank you very much.
Thank you very much, Diego. And let me follow up one of the issues which were touched upon in all these presentations, that maybe just come back to your idea of trust. And one would say it's very simple, that you can trust in something which you know and understand. And we also heard about the complexity of the issue and the limitations of the trust. So let's link trust, communication, and understanding together. And I would like to ask all the presenters, and it was also one of the questions which we got from the Q&A part, that please, I would like to invite you to comment on trust and communication and understanding issues. Maybe, Nick, you could start.
Well, thank you. Picking up on what both the previous speakers said, I mean, Gregorio was talking about an expert panel. And one of the problems with pensions is that it involves multiple skills. And one of the problems is that very often people think that funded pensions, what you need are financial market experts, and that's all. Pensions need financial market knowledge. They need knowledge of microeconomics, macroeconomics, taxation, labor markets, etc. So that when one wants to think about reforming pension systems, one needs to bring all those things to the party. Separately, one of the things I learned during my time on leave from LSE at the World Bank was that strategic policy design, the sort of thing that academics like me do, is the easy bit. The hard bit is implementation, making things work in practice. So I've always argued that effective reform, you need a tripod of skills. You need strategic policy design, you need the practical political skills to sell these things, and you need the technical skills on how you design them. But folded into that, there is a very important principle, I think, which is that, particularly for communications, which is the subject of this webinar, leaving things to the experts is a disaster, because experts cannot understand what it is that ordinary people don't understand. So when you have these panels, you need to bring all these skills together, but you also need to include people who are not experts. And when you design your auto-enrollment or whatever it is you design, you need to beta test it on a very wide variety of people. Because, as I say, experts are the last people to understand what it is that others don't understand. So I think what I've said is totally compatible with what the previous two speakers have said. Yeah, I just want to unpack and reinforce the importance of having diversity in the groups that design these things.
Thank you very much. Gregorio, Diego, any comments on trust and understanding? Who can you trust? Maybe, so in European context, we heard about the home bias. We are at home in Europe, we know, but still, when we retire, we don't have, David don't necessarily would like to retire in Paris. I don't know.
Yeah. Yes, well, I think communication is in fact the bridge between a complex financial black box and the person who needs to rely on it 40 years from now. In behavioral economics, we know that trust isn't just about the math, it's about the feeling of control. As Nick said, don't live in the hands of the experts, of the pension experts, the communication. Communication is key, and communication needs to be easy, understandable, and just in time, in the right moment. You need to communicate. I discuss very much with colleagues about financial education. Financial education as, say, a set of information, papers, documentation, so on. Well, it's nice, but it doesn't work because we need in the proper moment, we need to know how to decide, and for that reason, we need to have a specific just-in-time communication, and why not education? So I think the first way to gain trust is exactly to understand what is the problem of pensions and what options we have. And don't think people can understand everything about that. Using defaults, it's useful because defaults are analyzed by for the majority, the vast majority of people. So it's very necessary to design good default options. Of course, people who can choose other options, not the default. But to gain this trust is necessary to understand what we have on hands. For that reason, I think communication it's a key issue regarding the development of complementary pensions.
Tibor, I would like to build on the last two comments, and keep in mind that what we have shared for Spain in this case is one part of the let's say the pension committee that we have. So we have a group of people, okay, that are focusing on social security, which is I have described, then private pensions, understanding private as the second and the third pillar, the occupational or the employer and the individuals, and even there is a third area of focus, which is reverse mortgage or equity release, okay, which is from our point of view part of, it's more a potential a way to complement the public pension. Okay, so in Spain, most of the income, most of the pension income at the retirement age is provided by the social security. So the general income replacement ratio, so when we compare the first pension with the last salary, it's 80% in general. Okay, so we have only 20% of gap, okay, in order to maintain the previous lifestyle. Okay, so it is in this area where what mainly we are focused in order to encourage additional and complementary savings. We have a very limited pension market in Spain, even much more developed the third pillar, the individual one, than the second one, and is in this area where we think that we have the largest opportunity in order to diversify and in order to encourage this complementary part for the future retirement income. And is in this area where mainly we could be focused on encouraging people to save more in order to do that. Maintaining and saving, let's say, the public system, which is more or less the focus of the previous of my previous presentation, in which we were focused on, okay, let's provide data, results, technicalities, okay, to policymakers in order to, let's say, maintain and reinforce the current public system, and in a second way, how we could even to make people to save more, complementing the public pensions in order to reach this, let's say, 90, 95, 100% of the previous salary. So it's more or less what we are doing here in Spain.
Could I come in with something?
Yes, please.
I mean, following on from the emphasis on communication, if you want people to do something, you can either persuade them or you can tell them. Communication is part of persuading. Telling them would be a mandate. Short of that, you can nudge people. And so in a way, the issue is what is the relative balance between communication and nudge? And I just want to tell a short story that illustrates the limitations of communication to facilitate choice rather than using nudge. Many years ago, I was asked to write a report for the government of Sweden on their pension system. And the night before I launched the report, I was having dinner in Stockholm with two old friends, the person who was running the system and one of the key people who'd been involved in designing the system. And I was saying to them that if I was a worker in Sweden having to choose a pension fund from 800 pension funds, I said, I wouldn't have a clue. I said, if I was a worker in Sweden, I wouldn't know how to choose a fund from 800. I'd be in the default fund. And they looked at me, the person who ran the system and the person who'd helped design it. They looked at me and they laughed and they said, we're in the default fund, which makes the point that even when you know, there is a lot to be said for sticking with the default. This comes back to the point of trust. Trusted default, nudging people into it, is a separate approach from communication and trying to persuade people. And I just want to bring out this contrast or this counterpoise between communication and nudge.
Yes, thank you very much. One of the things which came to my mind hearing all this, that when we are thinking about establishing new systems, economies of scale, and so forth in European style, that there is a decades-old trend moving from defined benefit pension schemes to defined contribution pension schemes. And one of the side effects of this move, there are multiple side effects of this move. One is offering greater choice, which was not present in defined benefit schemes. Social security schemes throughout Europe, basically defined benefit schemes. But turning to defined contribution schemes, one of the reasons, usually explanation for this tendency, is that people understanding these schemes because this is similar to pension to bank accounts and also using credit cards and so on and so forth. This is at least some kind of knowledge about individual accounts. However, the side effect is having greater choice, and also kind of reluctancy on the side of the providers providing annuities. In Nest and in Sweden, it's mandated that there must be at least part of the scheme. So I would like to hear your opinion about generally from this that taking it granted that every new system should be defined contribution. Sometimes it was also a tendency in social security, the reforms going to a defined NDC system, and whether it should be kind of limited choice, and so how it comes as a new wave for the design. Thank you. Nick, please.
Well, I think while I'm skeptical of choice for most people, that doesn't rule out giving choice to some. So one option would be to have something like Nest with limited choice, but Nest could have a sixth option, which could be that if your accumulation is larger than a certain amount, you have the option of signing 40 times in blood that you know you're taking a risk, but you will choose none of the Nest's 5 funds. You will choose your own fund from the open market. So that would be a way of nudging people into something with deliberately limited choice, but not restricting choice for those people with the money and the interest who want to make use of it. And that way, you can go some way towards addressing a diversity in the population in terms of income, wealth, and interest in pension reform, in pensions.
Thank you.
Yeah, I like to add the behavioral perspective on defined contribution plans. I think from this standpoint, DC plans are inherently flawed because they shift all decision making and risk from the institution to the individual. And the individual is prone to several cognitive biases, present bias, choice overload, inertia, and so on. So for that reason, I think it's very important to use behavioral solutions. I try to explain briefly 2 of them. One is nudging and the other is choice architecture. There are some models, successful models, as all of auto-enrollment, well, not all, but most of the auto-enrollment systems. UK is the most known, but New Zealand, United States with 401k, and I don't know, Lithuania, Turkey, Italy is not the best example, but they run an auto-enrollment system as well. But in fact, the way to make things easy is the key to help people to deal with a thing as pensions that are difficult to understand. So we need to help them. In fact, saving hurts. It's difficult to save. So we need to give all the possibilities to people to do things in an automatic model, in an automatic way. As Nick just explained, if you have the option to know better, to have more money, etc., you can choose other options. But by default, we need to have a good system for the vast majority of the population.
Yes. Maria, maybe you have a question.
Yes. Apart of thanking very much all the speakers for these excellent presentations, I would like to ask Gregorio, what was the feedback received? Because communication is really, to some extent, a complicated issue, and to a high extent, it is linked with people's trust that was really shaken due to all challenges we had to face recently. So what was the feedback, Gregorio, from that initiative you took?
Thank you. I think that from politicians and political parties, I think that in general, this was very, very, very well received, okay? And even because at the end of the day, we are trying to build together something, okay? And provide some insights, okay? With data, with results, and they recognize us as a relevant part of the discussion. With the society, sometimes this was, I would say that pros and cons, because some of the people is so embedded with the ideology that they don't like to understand that the results are those that we are receiving. So sometimes they are even providing more credibility or trust to this dimension, more this political thinking, the ideology, than the results. At the end of the day, we are not taking part of any or other way, okay, in order to provide pensions, okay, from the public source. But it's true that even using a very simple communication language, very easy and fair statements, sometimes they are not very well understood or recognized by certain parts of the population. That's true.
Thank you very much. So another question which I would like to hear your opinion that is linked to the hybrid savings things in Nest. And actually, in my country, it was also allowed for a certain part of pension savings to be spent on housing. Fortunately, we have the experience for this, and it was not very popular among the pension fund members. Fortunately, I would say. And we hear that in Nest case, it is just a new experience, and I do not know that you have some close to conclusion about it or experience about it. But I would also like to ask Gregorio and Diego that if they heard any such opportunities in Spain or in Europe, because this was something which was first lesson for me in pensions, that pension savings must be saved with all tools, regulation, and so on and so forth, to be spent only in old age. And now we hear that maybe again because of public pressure, it can be used, at least partly, for other cases. And again, yeah, so I would like to hear your opinion and experience if you have.
Okay, by my side, I think a hybrid pensions model should be the right model in pensions. Let me say, I work mainly in Europe, but as well in Latin America, and there, you know, the models from, I don't know, 30, 40 years have been funding models, pure funding models. So they don't work perfectly. They have a lot of flaws that we need to solve. And by the end of the day, most of the systems are turning to a hybrid models with, I think the old theory of pillars is a good theory, still is a good theory. We need to have a set of pensions, non-contributory pensions, universal one. We need to have another pillar of it depends on each country, but another professional pillar can be pay as you go, because in our countries, for example, it's very difficult to move to a funding system. But we need to start to save. In fact, Europe is pushing the European countries to increase the savings, the pension savings. Why? Maybe not for the proper reason for us, that is better pensions for people. The reason is Europe needs, from a geopolitical point of view, needs to invest much more in their own industry, say technology, defense, ecological transition, green economy transition, and so on. But this is a train that we can catch, and this train is good for pensions. So I think we need to have this basic system for everyone. All the people need to have a basic pension, and we need to save more for pensions because it's good for the economy, but especially because it's good for us. But let me say that, as I tried to explain before, defined contribution models, they are the vast majority, we know, but are more difficult to understand to people. People like Goyo explained before, in Spain, people more or less know what is the pension, the social security pension in advance, and this is a percentage of the last salary. It's easy to understand, more or less. It's easy to understand, and the process of accumulation, it's most difficult. It's more difficult to understand. So we need to strengthen what are the ways to communicate and to explain and to make safe easy for everyone.
Okay.
Okay, from my point of view, and in order to share more about what is happening in Spain, because the conversation around auto-enrollment is on the table, okay? It is not easy and immediate to translate this into the legislation due to some legal constraints. Okay, the last. But this from my personal point of view, this could be a good nudge for the Spanish population, and I think that everybody in the market is pushing in the same direction in order to try to mirror what clearly Nicolas Barr explained about the UK. So today we have a very small part of the Spanish population saving from individual or even through occupational pension plans. Okay, as I explained, we have a high coverage from the public pension, which makes that that today the changes of the system are not very urgent, but we think that is important because probably in the medium long run, probably in some way due to a credit crisis or whatever any other reason, probably the Spanish system is going to be or the Spanish coverage is going to be reduced a little bit in the future. So we need to be ready to complement this public coverage that from the Spanish actual institution, our idea is to save and to make this first pillar as much robust as possible, okay, and to provide let's say the most relevant part of the income for the Spanish population at the present and in the future, as well as is happening in the past. But focus on this second pillar, which could include more diversification in the system through this auto enrollment. During the last pension reform, I'm talking about the occupational pension reform, only this was included the possibility to implement new pension plans for the whole industries, okay? And these were the opportunity to do that was only sitting on the collective bargaining. This means employer association and national unions, okay? We have only one case, in this case, the construction industry. Other industries are assessing and analyzing the possibility, but this is taking a lot of time. So probably if we are not able to move to auto-enrollment, understanding that everybody should have the opportunity to be included in a pension plan, in an occupational pension plan, the development of this second pillar, from our point of view, is going to take decades if we are successfully reaching that, okay? And then we'll have the second pillar on a voluntarily saving basis, or even what I mentioned in advance about the reverse mortgage or equity release, that could be another complement, or even other options that are more news are like pension for consume, that in which you are paying some bills. Part of this is going directly to fund your pension. This is on the table. Some companies are using that, but so at the end of the day, as you could see, we, from our point of view, we should use different sources in order to build a smart and fair total pension.
Thank you very much. I think we will have just time for one last question, and maybe it could be that we are talking about communications in general, and originally we were talking about communication by actuaries to different parties. But looking at it from the point of view of the people, of the pension fund members and insured people, what kind of communication they get from different sources in your experience, and what is your opinion about getting multiple information, multiple sources who are providing messages to the future retirees? I would be interested in your opinion. Maybe Nick?
Well, when you look at your credit card statement, it shows you the rate of interest you're paying. And it is a definition of the rate of interest that I think is set in law so that whichever credit card company you use, the interest rate that you are shown is calculated using the same methodology. And I think that ought to apply to pensions, that the information that's given to plan members, there should be a legal requirement that it takes a particular form, that it gives the various pieces of information that policymakers think ought to be there, that defines how you calculate and measure the variables that go into that statement, so that the statement that people get from their company will be the same, will use the same definitions for all companies, B, will be designed to convey information that is useful to the plan member, as opposed to what some fund managers might like to do, which is to build in complexity so that people don't know what's going on. For example, mobile phone companies offer deals that are deliberately very hard to compare to try to mute competition. And I think communication on pensions needs to avoid that by having a standardized form. And I think that would be the start. And then you test out the form on sort of people in the real world to make sure that it's intelligible. I think that would be my starting point.
Yes, very much. I think there is initiatives in Europe for this, that defining the pension benefit statement and so on and so forth. And we also have in Hungary some interest rates and costs decided by the regulators. So there are good news.
Yeah. Yes, I think, well, people in fact in their pension statement needs to know a very simple things. One is how much they have contributed, how much they have now, what their pension will be, and how they can act in an easy way. I think EIOPA designed a very simple template with, even though with this CTA, this call to action, allowing users to take easy and direct action to fix the retirement gap. So it's necessary to have a very easy and understandable pension statements. We need to forget some explanations, at least in the first step, some explanations about returns, especially short-term returns, about the composition of the portfolio, about many other things that only can confuse people. We need to show them easy information and useful information. I think this is key.
Yeah, thank you very much. And going back to social security pension systems, we know that, again, Sweden is a good example of sending out annual information, and there are other countries and initiatives in other countries, but there should be more of them throughout Europe. But unfortunately, our time is out. So maybe, Maria, would you like to say some words?
Yeah, again, I would like to thank you all very much. I would like simply to add that what is also important for the communication is also to consider the pension concepts that exist in each country, because every country has a different concept of what is pension. And if we wish to approach and to persuade people to trust, again, pension funds, we need to start thinking how these people consider what pension is. Thank you very much. We're really honored to have you today as speakers. I would like to thank our audience very much for these 2 hours, for attending these presentations. On behalf of the Social Security Subcommittee and myself, thank you very much for this excellent event. Thank you.
Welcome.
My pleasure.
My
Thank
pleasure
you
as
very
well.
much.
Thank you.
for the
Thank you.
speakers.
Okay.